The September quarter results of CCL Products were broadly in line with street expectations. CCL revised its volume guidance to 15% post the Q2 earnings from the 10 to 15% given earlier. Consolidated revenue grew by 4.5% on account of better realization. Both gross profit and gross margins improved year-on-year on the back of higher proportion and better realization in freeze-dried coffee, which is a premium product. Higher gross profits couldn't translate into higher EBITDA as it was weighed down by employee and other expenses. Capacity utilization for the India plant was around 90% for the September quarter. Improvement in margins for India business was led by volume growth. CCL plans to double its capacity in Vietnam from 13,500 tons to 27,000 tons. It is likely to be completed by September 22, subject to COVID not disrupting the plans. Capex for the expansion is likely to be around $20 million. The doubling of Vietnam capacity will free up India capacity and its ability to customize blends and higher growth for instant coffee markets. Domestic branded business revenue saw 40% year-on-year growth for H1 FY22 at 85 crores. The company is targeting a revenue of 200 crores for FY22. It also plans to ramp up capacity to meet pan-India demand by further deepening the domestic market. EBITDA margins are likely to be under pressure owing to higher coffee prices and the inability to pass on the price hikes. We remain positive on CCL on the back of its cost-efficient business model, expertise in coffee blending, and capacity addition in value-added products. The management has revised its volume guidance from 10 to 15% given earlier to above 15% plus now for FY22. The revision in guidance came on the back of strong order booking, upcoming peak season of December and March quarters, and the commissioning of 3,500 tons of Vietnam facility. The growth in demand is coming from product introductions, higher volumes from existing customers, and expansion into newer territories. The products of CCL are well accepted and have witnessed substantial growth in private label volumes, and this trend is seen across customers globally. Realization is also likely to be higher from March 22 on the back of rising green coffee prices. The order book for CCL is booked for FY22 and it has started booking for FY23 in advance. International business in the US continues to grow well and CCL is looking for more opportunities. Going ahead, CCL plans to focus on small packs for the US market. CCL is also targeting newer markets in Europe on the back of its strong brand visibility in most regions. CCL was facing logistics issues due to COVID, which is now improving with respect to the availability of containers. However, higher green coffee bean prices and freight costs are likely to impact margins in H2 FY22. Management has reiterated that it will continue to invest in retail brands and increase distribution network. It has also gone for capacity addition in value-added products like freeze-dried coffee and small packs. Based on the current estimates, CCL is trading at a PE multiple of 18x for FY23 projected earnings. Investors with a medium to long-term horizon can accumulate the company's shares at current level and add on declines. The risk to our assumption remains disruption at its Vietnam plant on account of COVID-19 and delay in replacement of MEIS scheme.